Welcome to our Market View presentation. Our group consists of two members, Esther and Ethan. In this presentation, we're going to talk about two currency pairs, which are Australian dollar to the US dollar and the Australian dollar to the British pound. We will be discussing four determinants of the foreign exchange value of a currency. There are relative inflation rate, relative interest rate, relative economic growth rate, and commodity prices.
Starting off with the Australian dollars, referring to the graph above provided, it is observed that Australian dollars is early appreciating against US dollars in early of 2018 and started to depreciate from February of 2018. According to the Reserve Bank of Australia, $1 of Australian is equivalent to 0.77698 US dollars as at 18 April 2018. The value of the Australian dollars rises and falls relative to other currencies around the world every day. AUD/USD is currently trading around 77.69 US cents, having briefly moved above 81 US cents in January.
The first determinant that we look at will be the relative inflation rate. The current inflation rate for Australia is 1.9% according to the ABS, while the inflation rate for United States is 2.1% according to the inflation data. As Australia has lower inflation rate than the US, it will experience more demand for exports, which leads to an increase in the demand for AUD. This also decreases the demand for imports, and therefore less supply of the AUD.
Next is the relative interest rate. According to the RBA, the interest rate of Australia is 1.5%, which has remained unchanged since 3rd of August in 2016. The low level of interest rate is continuing to support the Australian economy. Taking account of the available information, the board judged that holding the stand of monetary policy unchanged at this meeting would be consistent with sustainable growth in the economy and achieving the inflation target over time. While the US has an interest rate of 1.75% according to the FX rate.
With the information provided by the RBA and the FX rate, we can calculate the real interest rates of the AUD and the USD. Australia has a real interest rate of negative 0.4%, while the USD has a real interest rate of negative 0.35%. Since Australia has a higher interest rate than the US, this encourages capital inflow, causing the demand for AUD to decrease. This also discourages capital outflow, which decreases supply for AUD.
Australian economic growth slowed in late 2017, undermined by weaker construction and exports, offsetting strong rebound in household spending. According to the ABS, GDP grew by 0.4% in seasonally adjusted change volume terms in the December quarter, undershooting forecasts for an increase of 0.5%. September quarter GDP, previously reported as an increase of 0.6%, was revised up to 0.7%, with the quarterly GDP missing fractionally to the downside. The year-on-year growth rate slowed to 2.4% from 2.9%, below the 2.5% level expected by both the RBA and economists alike. Compared to 2016, the economy grew by 2.4% in 2017. On the other side, according to the Bureau of Economic Analysis, the annual GDP growth of US dollars is 2.9%. A higher economic growth will lead to increase for imports and supply of USD and shift the supply curve to the right. Next, Australia is one of the world's most natural resource-rich countries and has large holdings of gold, iron, copper, coal, and aluminium, and they are Australia's biggest export products. Australia relies heavily on trade for its economic well-being, a significant fall in the prices of commodities can contribute to a sharp decline in Australia's terms of trade. Our terms of trade is a ratio of export prices to import prices calculated by the Australian Bureau of Statistics and published every 3 months. As slowing demand causes the price of Australian resources to fall, it also reduced the need for Australian dollars, the currency used to buy them. Next, for the forecast of AUD and USD, we predicted that the Australian dollar will appreciate against the US dollar in the next 3 to 6 months. There are 3 reasons why the AUD will get stronger. The first one, the US economy slows down and the central bank fails to increase the interest rate, pressuring the USD. Second, the Australian economy picks up along with inflation, increasing the risk of interest rate hikes from the RBA. Last, the Chinese government artificially stimulates its domestic economy, driving up demand for Australian commodities and AUD.
Now we'll move on to the comparison between the AUD and the GBP. According to the Reserve Bank of Australia, as at 13th of April in 2018, 1 AUD is equivalent to 0.5467 GBP. According to the ABS and the Bank of England, the inflation rates are 1.9% and 2.7% respectively. This results in high demand for exports and the demand of Australian dollar. Shifting the demand curve to the right, this decreases the demand for imports as well, therefore less supply of AUD and shifting the supply curve to the left. According to RBA, the interest rate of Australian dollars is 1.5%. On the other hand, the interest rate of British pound is 0.5%, according to the Bank of England. With the relevant information provided by the Reserve Bank of Australia and the Bank of England, we are able to calculate the real interest rate. The Australian dollar has a real interest rate of negative 0.4%. The British pound has a real interest rate of negative 2.2%. With the higher interest rate of Australian dollar, investors would prefer to invest in the Australian dollar rather than the British pound, as the return of investment is more appealing. This will increase the capital inflow and the demand for AUD, therefore shifting the demand curve to the right. This will also decrease the capital outflow and the supply for AUD, therefore shifting the supply curve to the left. This will increase the exchange rate of the AUD.
Next, the annual GDP growth rate of UK is 2.3%. However, according to the Office for National Statistics (ONS), even though the GDP grew by 0.5% in the fourth quarter after expansion of 0.4% in the previous 3 months, but is still the slowest pace since 2012. City economists hence forecast growth of 0.4%. Darren Morgan of the ONS said the boost to the economy came from recruitment agencies, letting agent head office management, adding that there was slow and unsteady growth elsewhere. Particularly in consumer-facing sectors, the UK has suffered over the past year as rising inflation, prompted by the slide in the value of the pound after the EU referendum, outstrips weak wage growth, denting the spending power of consumers. In the next 3 to 6 months, we predict that the Australian dollars will appreciate against the British pound. This is because the Australian dollars has a higher interest rate and a lower inflation rate. Therefore, it's recommended it to invest in the Australian dollars.
In conclusion, AUD will appreciate against the USD and the GBP as well in the next 3 to 6 months. Thank you.